Hello and welcome to Quilter Cheviot's Markets Uncut podcast, your weekly insight into the topics and trends that we've been exploring here for you at Quilter Cheviot. Remember, so you don't miss future episodes, be sure to hit the follow button on whichever streaming platform you're listening on, or by following hashtag QC Weekly Comments on LinkedIn. I'm your host, Suneet Kumar, investment manager based in our London office. And this week I'm joined by Richard Carter, our head of fixed interest research, and Chris Beckett, equity research analyst covering consumer staples. Good morning to you both. Richard, if I start with you, investors have had a fair bit to digest this week with, amongst other things, both the Federal Reserve in the US and the Bank of England deciding to keep interest rates unchanged. What do you think has been the most important development from a big picture perspective?
I think big picture is still what's going on in the Middle East, and we've got into this awful cycle where Trump sort of talks up, an impending big attack, the biggest since the Second World War or something like that, and then sure enough, a couple of days later, if even that. Someone calls him up from Saudi Arabia or something and suggests this might not be a good idea, and he decides not to go ahead. So the oil price obviously keeps moving up and down based on whatever his latest comments are. We're all getting pretty bored and sort of used to it now, but it makes life pretty difficult for central banks. So clearly there is this risk of inflation, but last week both Bank of England and the Fed decided not to go ahead with rate hikes, hoping that perhaps these inflation pressures would be contained. So that's really the big thing. It's not making investors' job easy, the fact that the new person in charge of the Fed basically doesn't like sort of saying anything at all. So it just sort of says that, we're going to try and keep inflation under control, but at the same time doesn't say how that's going to happen or whether he even thinks inflation is high at the moment. So both him and Trump are keeping us all guessing, I think.
And when you look at bond markets today, what are they saying about the outlook for growth, inflation, and central bank policy over sort of the next few months as the year progresses?
Well, I think there is a kind of belief or hope that, this sort of Iran thing will get sorted in the end, because I think if you assumed it was going to go on for another nine months to a year, then markets should be a bit more jittery than they are. I mean, bond yields have risen. Both the UK and the US market are pricing in rate hikes, but they're not pricing in much in a way. They're pricing in one for the UK later this year and just over one in the US. So I think the general assumption is that growth's just about okay. Inflation is elevated, but we kind of know why that is. That's kind of the oil price, and the hope is that as I say, that will get resolved at some point. So overall, bonds haven't had a great year compared to equities, but the outlook seems relatively benign.
And there's sort of looking ahead briefly, is there anything you've sort of got your eye on in particular in terms of data that could change views on sort of market outlook?
There's payrolls sort of coming out this week and things like that. They're important, the employment numbers for the Fed, obviously. But I think overall, as Chris is going to talk about, corporate earnings are pretty strong. You've got the whole AI trade going on anyway. So we'll see what Trump does with Iran. Hopefully that will get resolved. I mean, also in the UK, you've got the Andy Burnham almost honeymoon period at the moment. I mean, he doesn't seem to have done anything, of any particular importance other than, update his social media accounts. But, that seems to have kind of, those worries about Andy Burnham and spending seem to have settled down. But we now know the date of the budget's going to be October half term, actually. It's going to be October 28th. Clearly for investors in the UK, that's going to be something either to look forward to or dread, depending on your point of view.
Thanks, Richard. Always good to hear thoughts on the overall sort of big picture backdrop. As you intimated, we're also right in the middle of earnings season. So, Chris, I'd like to bring you in here, please, because you and the team have been spending much of the past sort of 3 weeks or so analysing company results as they've come through. How has earnings season gone so far?
We're just about just a little bit over halfway through earnings season. So, and we've heard from most of the really significant companies. So we've got some good trends. You've got to say it's been strong. Earnings growth in America has been just above 20%. In Europe, 22%. So in absolute terms, a very exceptional period. You've got a lot of companies benefiting from the huge wave of AI capex. So sales lines are looking good. Average American company, 86% of American companies have beaten on earnings, 70% on sales, a little bit lower, and it normally is in Europe. About 60% of European companies beating on earnings, and the same on sales. You're getting very broad-based strength. And if I look sort of closer to home of UK European companies, healthcare, financials, IT companies, all doing well. And as analysts, we care more about what's going to happen in the future. So the guidance we're getting from company managements matters more. But 60% of companies are guiding earnings expectations for the full year higher, which is a pretty good proportion. Trouble is, it hasn't actually felt that good. You look at equity market indices, particularly tech-heavy equity market indices. You look at the Nasdaq in the US or the Korean market. Those tech-heavy indices have been pretty grim. The AI semi-cap equipment trade, memory stocks, they've all been rolling over a bit. Been very volatile. They've had good days and bad days, but net have been off. In most markets, most developed markets, you've had other sectors offsetting it. So the FTSE's up by a little. The US market is flattish. I think it's when you start looking at the reaction of markets that you get a true sense of where expectations were going into earnings season. If I look at America, for companies that have beaten expectations, they've gone up by average of 0.1%. So pretty much the market has been indifferent to good news. Bad news, the stock's off by an average of 1%. Those averages cover a whole range of stuff when you dig into the detail. But far more of a reaction for companies that haven't been doing so well than the equivalent positive reaction from companies that have been doing well.
And if we focus in on consumer staples, which is your sort of area of expertise and focus, it feels like we've had a couple of years where many of these companies grew by putting prices up. It will be great to get your insights just broadly into the health of the consumer, and also if businesses are finding it now harder to pass on further price rises.
It's really been, and as you allude to, the pricing and inflation that's been coming through for consumer goods. Everybody knows about that. Every time you go to a supermarket, things feel expensive. That's why people believe that the cost of living crisis is getting worse, even though the whole economy level, wages are growing a little bit faster than inflation at the moment. But it's felt pretty grim because those prices we are paying keep going up. That's really the result of when we came out of the pandemic. So going back 5 years and more now, there was excess demand in the economy. There wasn't enough stuff being made and shipped to the right places. So companies' normal reaction when there is that excess demand is to take the benefit in terms of higher prices. And that did well for the sales line for a lot of companies. It's more mixed now when I look at consumer companies, not always in a good way. So I had Procter and Gamble, biggest US consumer company or household goods company, report last week. It was balanced between sales growth from pricing and sales growth from volume. Trouble is, it was both balanced at zero. They were getting nothing from pricing and nothing from volume. The better companies, so something like Coca-Cola that's performing very well at the moment, was getting 5% extra from volume, selling more bottles and cans of Coke around the world, and a couple of percent from pricing. Companies are getting very scientific about taking pricing. And I think Better companies, we're showing better underlying demand coming through from those volumes. And overall, it is a bit more balanced when we look at where that growth is coming from. A lot of companies still pointing out the so-called K-shaped economy. If you're the type of consumer that is exposed to asset prices and financial markets, things feel pretty good. And our danger is our types of clients have been enjoying pretty good growth, particularly in equity markets over the last 12 months, and so are feeling relatively prosperous. That feeling doesn't go across the whole economy. The other side of the K, lower income demographic groups are finding it tough, and that's where it's more difficult for companies to generate higher sales.
And sort of looking at it from a slightly different angle, when you look across a geographic split for these companies, how are those companies sort of faring in North America and Europe compared to, say, emerging markets? Are you noticing some different sort of trends coming through from those sorts of areas?
I suppose the big trend, the mega trend, is an ongoing one, which has pretty much been happening my working life. Emerging markets outperforming developed markets. You have volatility and hiccups along the way, but overall, the growth in the economic growth in emerging markets is higher than developed markets. The demographic trends are better. There are more consumers who can afford to buy more stuff, and if the companies we're investing are putting the right sort of stuff in terms of branding and the proposition that they are putting in front of consumers, they're generating higher demand. So companies like Unilever, very well positioned in emerging markets, a few of those accidents from history, the level of distribution that they've got in places like Indonesia and India, their Asia Pacific region grew 9%, grew sales 9%. So where I'm looking at sort of low single digit and trying to say a good company is getting 3 or 4 and a bad company is getting 1 or 2, a region of the world that's almost double digit is very good. Company like Mondelez, who owns Cadbury's chocolates, sell Oreo cookies. Their emerging market business is growing at about 4.5. Their developed market business was growing at 0.7. So there is a big difference between emerging markets and developed markets, but that's something that is expected and something which is really nothing that new, but gives us reason to like companies with good positions in emerging markets, both branding and product and distribution. What has come through, which is slightly more interesting and slightly newer, is the divergence between the US and Europe. You'd think that the US is tougher, gasoline prices going up, getting closer to $4 gasoline takes money out of consumers' wallets, particularly in lower income demographics. But if you look at the market as a whole, consumer goods companies exposed are getting much better sales out of America than they are out of Europe. There are areas of Europe, particularly places like Germany, where it's very difficult to grow sales. Retailers in Europe are pushed back on price increases far more than retailers in the States. So a number of companies being delisted by significant retailers. Eventually, in a month or two, they'll come to an agreement over pricing for the next year. But this time of year, it's a little bit patchy. And if you are selling to the Carrefours, the Aldis, the Tesco's, etc., they can play hardball. And it's not an easy environment to get those price increases. And that's what I'm seeing in European sales numbers. So better in the US and even better in emerging markets than Europe.
Thanks, Chris. Really interesting to hear your insights. I think what we've heard today is that while headlines remain focused on things like artificial intelligence and, of course, geopolitics, the picture coming through from earnings season has been broadly encouraging. I think it's also a reminder that earnings growth isn't coming from just one part of the market, which should be supportive for well-diversified portfolios as we move through the second half of the year. So on that note, thank you both for your great insights, and to all of you for listening. Did you enjoy our discussion on the podcast today? We love to hear from our listeners, so please review the show wherever you're listening and share it on your socials and tag us at Quilter Cheviot. And to make sure you don't miss a future episode, tap the subscribe button. We'll be back next week. In the meantime, you head over to our website, quiltercheviot.com, where you can read the accompanying market overview and subscribe to our weekly comment newsletter. You can also stay up to date with our thoughts and market views, industry insights, and our upcoming events and webinars on our website or our social media pages. Finally, do you have any questions you'd like to ask one of our experts for our next podcast? Simply ask them via the weekly comments page on our website. We love to hear your questions. And that's it for today. So thank you, Richard and Chris, for your time. And thank you all for listening. See you next time.
This podcast is marketing material, not investment advice or research material. Investments can go up as well as down, and past performance isn't a guide to the future.